Good morning, everyone. This is Mortgage Pros 411. I'm Audery Boyce-Noe with Kevin Casey, and today we are joined by Diego Sanchez, who is the president of HW Media. Actually, I thought I changed that, but apparently I didn't. So, anyway, I know who you are,
That
Diego.
would be housing wire.
What?
More well known as Housing Wire. That's right.
Yeah.
Exactly, exactly. But I feel like we went through this before, where it was like, okay, I know better. I always like to think about Diego's background because it's not our normal guest, which I think gives us a great perspective because you come at things a little differently than Kevin and I might or someone else might. And also, it was interesting when I was looking at Kevin Warsh's uh,
Comment?
five Fed tax force members. Out of 15 members, three of them are from Harvard, Diego.
Oh,
So
interesting.
that would be your alma mater with an MBA from Columbia. So obviously a complete ding dong. Then worked at Credit Suisse, Microsoft, Travelzoo, and Rodale, and then joined Housing Wire, what, 8 years ago, 9 years ago, something like that?
Yeah, it'll be 8 years exactly in August. So
What made you think that was a good idea? Let's get into the mortgage space. What drove that idea?
it was like a lot of things that happen in our careers. It was through connections, right? I
Yep.
had developed a connection with Clayton Collins, the CEO of Housing Wire. And when he led an investor group to buy the business, uh, exactly 10 years ago, this summer, he did that with very little media experience in his background. He had banking experience. His dad was an LO, so he had mortgage experience, via family connections. And but he didn't have the media background. And I'd been working in media for a long time before I joined Housing Wire, and but on the business to consumer side. And so, we connected. It was a really good connection. We stayed connected for about like a year and a half while he, attempted to turn things around at Housing Wire. And it just made sense 8 years ago for us to team up
Mm.
and build this business together. He brings the banking, the corporate strategy, the finance background, and I bring the media operations background. And it's been a really amazing partnership for 8 years. We've been growing ever since. We've done 5 acquisitions in the past 6 years. We've also grown several businesses organically, including our events business. So really kind of a very good match. And the power of connections, the power of LinkedIn.
Was
That
that a
is really something else. We had him on our show back during lockdown at some point. Pretty sure there were dogs barking. I love it that you are a part of this powerhouse in it from really close to the beginning, and you're still doing the show today from your mom's basement.
Yeah.
So,
I've come
way
really
to
far, Audrey. I've come really far.
way to keep your feet onto the ground, Diego. Way to keep your feet on the ground.
I'm just trying to keep it real, trying to
Hey,
keep it real.
Diego, was he a Harvard connection or other connection? Just curious.
No, he was kind of media business connection, a connection of mine that I had developed, over multiple conferences, and somebody that lived in New York, where I usually live, went to school with him, and so that guy connected us when Clayton was kind of looking around for a little bit more operations experience.
Nice.
Interesting.
I,
All
I
right,
had,
so a little
I was,
detour before we get too deep into the weeds. First of all, we have summer camp from the California Association of Mortgage Professionals coming up July 23rd and 24th. They are at, they've really, really got a bunch of people going. So that'll be a good one. But they also wanted us to mention that there will be a credit class where you can get a certification from NAM on Wednesday, July 22nd. And for $199, you get the class and you get membership in camp. So sign up.
that,
Oh,
that 199 could pay for itself with one deal.
I
I,
know.
I've had it this last week alone. I had two clients who were just under the 720 magic number for credit scores. And in both cases, I was able to coach them on how to get their scores just over the 720 for a minimum amount of money. Um, I think one had to pay a $5,000 credit card. That was the big one. But other than that, there was little like pay a few $100s here, pay a few $100s there, and got them over. And one of the clients, the rate went down by one entire percent. One.
Yeah. We aren't promising that you're going to learn how to fix someone's credit in this class, but you will get a real dive into Vantage scoring and how that works and how that might impact things. So anyway, it's worth it because these days we really are educators first. If you are a good LO, if not, you're just out there, banging it out, trying to get some notches on the.
Yeah, sorry.
Uh,
Your 19 credit score. Here's your rate. Too bad for you.
what'd you say?
I said, too bad your rate 719. Here's your rate. Too bad for you. Versus, oh wait, we can move that score for you.
Well, I mean, and that is really the whole point is there are so many things that you can get when you work with, a human with a brain. So also IMB told to remind people to go to thecampsite.org and use code CAMPCCS to get the $100 discount. So, that's the discount. Oh, there's a discount. Okay, so if you
wait, I think you said the code wrong. Say it again.
CAMPCCS camp. I literally printed it. So from El Presidente, Jason. So
it's just 26. That's the trick. Because I was typing 2026 and couldn't figure out why I wasn't getting.
Okay, great. Go to the campsite.org. And if you have any trouble, call Jason Bellevue, the president of camp. He'll help you. Just kidding. If you need help, we'll figure it out too. But I literally printed that from his text to make sure that I didn't screw it up. So here we are. All right.
I think he might even be on the podcast today.
He is. Okay. Oh my God. Look at that, Kevin. It's in writing. You are correct for the credit class, Audery. Audery, I got one right. What do you know? Wow. All right. Buy a lottery ticket today. Okay. In other news, Kevin Warsh is testifying in front of Congress today and tomorrow. It'll be interesting to see what he has to say because he has said he doesn't want to say a whole lot. So we'll see how that works out in front of Congress. What are your thoughts on that, Diego?
He has said he doesn't want to say a whole lot. He also took this job, and lobbied for this job with Trump with the intention of cutting rates. But also, in his first press conference, talked about that inflation benchmark of 2% being pretty rock solid. So I'm already feeling a lot of potential tension that needs to get worked out here, right? Because the inflation reading today was a beat, but it was still 3.5%, which is well north of 2%. And so I don't think you can cut, which is what he sort of committed to Trump when he was lobbying for this job. So it'll be really interesting how he works all this out while staying pretty quiet in terms of his relationship with the market. There's a lot of tension there that it's going to be tough to resolve.
I think it's going to be interesting with him because I felt like he was very much on the we're going to cut bandwagon up until about the time he was getting confirmed. And then he took a much more neutral stance from what I was reading. And then he was more, we're going to do what we got to do, right? Which I think was good for the markets because if he had maintained that I'm going to do whatever I'm told position, the markets would have hated it and it would have been a huge problem. So I feel like he's moderated from that original, I'll do what the boss says I should do into something a little less stringent. He also has talked, and we've talked about this on here, where he's thinking about whether or not we should steer away a little more from PCE core at 2% and go to that trim means idea, which sounds like that could go either way. It is early. This was they released the minutes from the July 17th meeting, and the Fed it's very divided. It was 8 voted for no changes this year. 9 said they're expecting at least one hike, everyone was united and voted to leave things unchanged. But we don't know because, again, the Strait of Hormuz is open. It's closed. It's open. Oh, wait. I don't know. Maybe we'll charge a 20% thing. Maybe we'll take I mean, it is crazy right now. So all bets
So
are
good
off,
time to lock. Good
What?
time. Good time to lock.
Oh my God. So yesterday, I had somebody go into contract over the weekend, and yesterday it was like, I kept going, we got to lock now, not to them so much as, as I'm getting my people to lock, I'm like, push the button, push. Well, it's showing is that just push the button right now so that we've locked in our time and, date, and we can fix it later. But anyway, it was nuts. But then the market recovers today because, again, we got a good CPI number. But to Diego's points, this is from June, and oil is up, oil is down. I mean, it is so nuts out there that just lock.
Yeah, I mean, that's right. I mean, we what we know is that there's upside risk and there's downside risk. So the risk is that it's volatile, and I think in that scenario you lock, right? Like
Yes,
if volatility is what's happening, so yeah, I just think it's going to be really a very very interesting time because you have a president that is not known for patience, right? And he wanted somebody who was going to come in and cut. His thesis is that we can still cut. I think it's correct for Warsh to come in and be more neutral because like he's just one vote. Now
right.
it's a very influential vote, but he's just one vote, and there are, to your point, more than a majority of the other votes that are in sort of the hawkish camp right now. And so that's a tough hand to be dealt if you're trying to cut right away. And so we'll just see how much patience there is, right? Like Trump lost patience for Powell. Uh, Powell was was his choice.
Yes, yes,
Way back in the day. We probably a lot of us forget that.
yes.
How long is their patience for what is probably the correct, more neutral stance that Warsh had in that in that first press conference? How much patience is there from that from the top?
Yeah, 100%. And also, again, always remembering that if he just does what he's told, the markets are going to react adversely. And historically speaking, just because the Fed raises or lowers does not mean that mortgage rates are going to at least immediately follow suit. So it's all based on what does the market think about that decision, and do they think it's going to be good in the future?
Yeah, and it's so interesting what has happened over the last year and a half or two, where Trump keeps threatening to fire members of voting members of the Federal Reserve, including Powell. And we just had a Supreme Court decision that makes it pretty difficult, if not impossible, to fire somebody on the FOMC.
Hmm.
And so, does Warsh, is he good now that he's in, right? Like, did he lobby for the position with a certain stance and now is like coming in with his more accurate viewpoint? I don't know. It'll be interesting to
I
see
don't
how
either.
Yeah.
it'll be interesting to see how it all plays out over the next 6 months.
Exactly. I mean, for us, we need to know that that's all happening, but we also just need to stay focused on what do our borrowers need today. And Diego, we have a little ditty we like to sing here. You might want to adopt it, maybe sing it out at a conference or something in a crowd of a zillion people. If you see a rate you like, lock it in. We have been doing that since 2020, March 2020. And it really, when I forget about it, it always bites me in the tail. But it is really a matter of we can only play with the rates so much before we get bitten.
Yep.
And so, really, just you always have more to lose than to gain when it comes to messing around with do you lock or not.
Yeah, and to your point about the Strait of Hormuz being open and closed, I don't think we have a near-term resolution for that.
No.
I think it keeps opening up and shutting down. You have two sides in this conflict that are, can be fairly dug in at times and fairly stubborn in their position.
Yep.
And I actually thought that a couple weeks ago, this ceasefire was Trump actually giving on a lot of things to make that ceasefire happen. And but you see Iran, like, they're still willing to mess around. They're still willing to play around here when it comes
Yep.
to control over that strait. And so when you have two positions that are like polar opposites, it's really hard to find a meeting point in the middle. And so I think we may see, like I said, open up, shut down. Is there a toll? Is Iran charging a toll? Are we charging a toll? Are we both charging a toll? That confusion is going to last, into 2027. And so again, that speaks to the volatility that will likely be in place. And like, that song is it's a good one, right? Because when things are volatile, lock in something good.
Well,
Yep.
it's also telling because the oil prices had bumped way up from like 67, $68 a barrel to 120, I think was where we topped out. They came back down to like within $1 a barrel, and we still didn't have the rates didn't totally rebound to where they had been in February. Now we're up to, I think today we're around $80 a barrel. I mean, don't quote me on any of this. God knows it could be changing as we speak, but the market is aware that it's volatile, so you're not seeing immediate or even quick, slightly quick responses to these decreases in the price of oil. So Tina says, Audrey, if you're it should be, if you're happy with your rate, lock it in. And I just would like to point out, no borrower is ever really happy for the most part,
Never.
and
Never.
whatever you lock in, they're going
And
to
they always
think
want
because
more.
yeah, someone told them, oh, I got this, and then they're going to think they should have that, and are you sure? And oh my god, it's so I've told the story a number of times. You can cover your ears if you're sick of it, don't care. But during lockdown, when rates were at their lowest, um, I was talking to a financial advisor, and we were discussing a $2 million loan, interest only. And I was quoting him like 2.25%. And he said, I was really hoping for something lower. And I said, I said, do you hear yourself? I mean, do you hear yourself? I mean, what the hell? So it doesn't matter. So every time everyone keeps saying, "Oh, well, if only rates would get below 6%, if only rates would get to 5.5." No, no, we're gonna get to 6, then they want 5.5. We're gonna get to five and a
There,
half, then they want 5, 4, 3. I mean, it never ends. So
there's
just
just
get
no
over it.
there's just no chance that we're getting out of getting below the sixes anytime soon.
Yeah.
There is too much volatility with the Iran conflict. There is too much. I mean, you have to remember, before the Iran conflict happened, we already had CPI and PCE that was well north of that 2% benchmark.
Way.
And, people were talking about, there being inflation related to the tariffs. People were talking about there being inflation related to some of the immigration restrictions and other things that have been happening in our economy. So even going into the conflict, we were still north of where even now Kevin Warsh says we need to be. And so to think that we're going to get, I think we're at 6.75% today for 30-year conforming. To think that we're going to drop, 70 basis points in the next couple of months, it's just very unlikely to happen. And so I think, we should be advising and talking to our borrowers about that volatility and about the global economic uncertainty, and being comfortable and being able to afford with rates in the 6 to 6.75% range.
Yeah.
Yep, exactly. And Rick notes rates always get worse faster than they improve, which is so true.
Yeah.
If you don't lock, you can't close. That is truth. So, again, it's easy to get caught up in, oh my God, if I could just get a little better. And I get it, especially when rates are going down. You do have to watch it because we as LOs have to deal with EPOs. So EPOs are a big problem. And if we lock somebody in and we have not gone in as tight as we can on their rate, it is much easier for them to refinance in 2 or 3 months and then everyone's SOL.
And I
It's a
know it's
technical
frustrating.
mortgage term.
I know it's frustrating because there was that, I think it was one day where mortgage rates dropped to 5.99, high five nines, right before the conflict with Iran.
Yep.
But you just you can't walk back going to war. Like you
Nope.
may want to be able to get out of it unscathed, but there's
Yep.
another party, and like the old expression, it takes two to tango. And if Iran doesn't want to let us out of this conflict, if it's in their best interest to control the Strait of Hormuz, which I think it is, it's going to be a really tough conflict to get out of unless Trump is willing to, um, sort of withdraw from the strait and give Iran that control over that strait, allow them to charge tolls, whatever they want to do. I just don't think he's going to be willing to do that.
I don't think so either.
I think they decided that the toll was illegal, but they came up with some other word to describe the 20% they were talking about. I forget what do you remember what this is? Because like
I don't.
anyway, yeah,
It's
they'll
the
find a
service fee.
workaround some way. What,
The
Kevin?
service fee.
What?
The service fee.
A service fee. Exactly. It's an admin fee. We have admin fees. So it's not points, it's admin fees. Okay. So on that note, because we are so subject to what's happening both in the economy and with what's happening globally. So Wednesday, we have PPI, which is wholesale inflation. So that'll be our next little peek into what the Fed will be looking at when they're making their next rate decision. We'll have the Fed beige book. That's always interesting. Thursday, we have retail sales and pending home sales. And then Friday, we have starts and permits. So just, buckle up, people. It is not going to get any easier out there. And just again, focus on what do you have in front of you? What's the best you can do for your client? Kevin was talking earlier about what we do for clients as far as fixing credit or helping them, guiding them to maximize their credit. And it's not, I've heard people who aren't us talk about, oh, well, you shouldn't do that. And what do they call it? There's some words like manipulating. That's the word. Oh, you're manipulating their credit. And I'm like, you're helping them understand how the model works and maximize, because a lot of times they just don't know what they're doing. And
Nope.
that's why they're in the position they're in. And it is our job, I think, to make sure that they are getting the best possible scenario for themselves, right?
And there's a difference between credit repair and credit optimization, right? So
Yes.
credit repair, is for somebody that has had some real difficulties, and perhaps a bankruptcy or just really real significant financial difficulties, and they need to work with an agency to repair that credit. And there have been some shady issues in that ecosystem for sure. Now, credit optimization, like what Kevin is talking about, where like, okay, maybe just pay down this to this so that your outstanding debt is this percentage of your overall income. These kinds of tweaks that aren't shady at all. They're
Exactly.
just it's just math, and it's how the credit agencies score us. That kind of optimization is really smart from my perspective, and actually creates new opportunity, right? Like if you have, like Kevin talked about, if you have somebody that is just below qualifying for a really good rate, or just below being able to go into a certain program that you're familiar with. Like making those few little tweaks makes a ton of sense and actually creates business for you.
Well,
Yeah.
Kevin was talking about how he lowered his client's rate by what, a point, you said, Kevin?
At
An
one point,
entire percentage rate.
yeah, went from
Yeah.
9 point something to 8 point something. This is our second loan, so but still, it was a large second loan, $250,000. So
But that's a dramatic, it's just a dramatic decrease in
yeah,
the rate
Yeah.
now,
Huge
as you
now
went
the
decrease.
in.
same, the opposite is also true because sometimes you can't help stupid. And I had two cases this week where people like, okay, we're situation we're in, and oh, they forgot to make their mortgage payment right during the process. You're like, how did you do that? Like, you just really undid all the work we're working on here. So, yeah.
Well, I just had one yesterday where this guy who I didn't even know who I was talking. I was told, "Hey, I've got this scenario. Could you do a private money loan for him?" So I'm like poking around on the scenario. Come back, I've got some possibilities. Then I find out who it is, and they had skipped two mortgage payments. I'm like, in what universe did that seem like a good idea? I mean, what the unbelievable. Anyway, so it is it, and again, to Diego's point, we are not talking about hiding bad credit or trying to show that you didn't have a bankruptcy when you did. We're literally talking about, okay, is everything reporting correctly on your credit report? Can you pay off this or do that? That kind of thing. We're not at all talking about, you know,
Don't go out and buy the new truck.
yeah, exactly.
While we're in the process, like like again, like this kind of stuff happens, and it's all about that education about those ratios and the math behind what how you're scored. That's really valuable advice that folks can give their borrowers.
It is. Well, Kevin, they're asking Kevin, what tool did you use to
You know
raise the
what?
FICO?
We switched the tool just recently, and I don't know the name of the new one. But most credit um, bureaus that you're working with, they have a tool that you can use to run a scenario for you. So I
Yeah,
just
they
depends on
do.
the companies you're working with.
They definitely do. There's something else I was going to say and I can't remember. So we're
Audrey,
done.
I wanted to just jump in on the point about like paying attention to what's in front of you. Despite all the volatility, all of our challenges with mortgage rates this year, post Iran conflict, um, there is still a decent amount of demand out there. There are
Yes.
folks who have been forced to sit on the sidelines for the past 4 years just because of complete unaffordability with mortgage rates high and home prices super high as well. But what's been interesting this year is you are starting to see the bend in that curve in terms of home prices. Either not continuing to rocket up like they were
Right.
for 3 or 4 years. We might actually see we are seeing some decreases in certain parts of the country, and maybe nationwide we'll see it stay flat or even decline a little bit. That to me is good. It shows that sellers are becoming more realistic in
Mhm.
terms of their asking prices. We've seen pending, and we have proprietary data on this at Housing Wire. We've seen pending home sales on a weekly and rolling basis, pretty far ahead of last year's pace. And we have seen uh, sellers decrease their listing price in a healthy way. Again, like willing to accept and negotiate more fair prices that really than they ever have been. And if you look at the MBA purchase apps index, it's been ahead of last year for almost the entire year.
Yep.
And we've seen good week over week growth in several periods of the year. And so all that to say that like, oh, and by the way, there's pretty good inventory available out there, much more inventory than there has been, when we had a pretty difficult and frozen housing market for those few years at the end of the pandemic. And so there's a lot of opportunity there. The demand has stayed active. And so if you can make scenarios work for people, if you can lock in rates for people at the right time, there's definitely opportunity out there.
Yeah.
Well,
Except one
again,
place.
we got existing home sales for June, and year over year, sales are still up 2.8%. So
Yep.
that's great news. Active listings, not to be confused with, okay, so there are inventories down 0.6% to 1.36 million units, but it's up 1.3% year over year. That's not a dramatic increase, and it's a good thing that we have a little more inventory. But again, those numbers don't include those properties in contracts. So we have like 1.1 million active listings, which is not a lot. So, and it
It's not a
also,
lot, but it's more than it was
yes,
for those couple of years where,
yes,
I mean,
yeah,
Logan Moshami
exactly,
called that a savagely unhealthy housing market because of the high prices and the lack of inventory, and the high mortgage rates. We're not in that scenario anymore. The
right.
historically the mortgage rates we're at right now, obviously it's more than the threes where we were for a couple of years, but none of us wants to go back to the economic and global situation that we had that led to mortgage rates being in the threes. We had a global pandemic. I don't think any of us wants to go through that again anytime soon. And so, historically, if you can lock in the sixes, and maybe over the next couple of years, there's an opportunity for rates to go into the fives, maybe refi at some point. Um, if the math works from an affordability perspective, demand is absolutely there.
Well, so Diego, this absolutely predates you, probably maybe even your birth. But when I joined the business, we were in 9, 10, 11, 12% were the interest rates. And so when we hit 6.5%, we thought that it was Christmas every day. We really did. And so I do think people forget why we had 2%, 3% interest rates. And they often yearn for them. And I at least verbally smack them around a little bit and remind them that to get back to that point, we would have to have catastrophic world events that we don't want or shouldn't want. And also, look what happened to home prices when interest rates went that low. It was a feeding frenzy. And
Oh yeah.
that, I think, really was a terrible contribution to what happened with the values skyrocketing, sometimes 20 to 30%. Very unhealthy market.
Well, I know it's really tough to go from here, way down to here, and then sort of struggle every year to grow a little bit, when you had such a great, couple of years. But the reality is, like, this is probably it's a fairly balanced
Yes.
housing market.
Very balanced.
And
Yep.
I think it would be great. I think it could probably still stay balanced in the high fives, but you
Yep.
get much below that, and you may have, go back to more of an unhealthy price increase situation. Um, it'd be nice to be in the high fives and still have a balanced market, but it is what it is, right? And
Exactly.
every day, more people leave that 3% rate that they got during the pandemic, for a 6% rate. And I think, as of a recent report, there are now more people in the sixes than there are in the threes.
Really?
And so, it starts to get a little bit more imbalance from that perspective. Lock-in can be a little bit less of an issue really every day that people take out mortgages and leave that 3% mortgage rate behind.
Exactly. And people need to live their lives. And we really got away from that being the primary focus of mortgage lending because we had a lot of companies who decided they were going to scale and they were going to make more money, more money. Then they go public, then they have to report quarterly earnings. And if they're not showing that they're growing, then it's all bad. And what happened was the consumer got lost in that. And so costs to do a loan have skyrocketed, et cetera, despite all of this amazing technology that's supposed to make us more productive and better. So I think that, again, I keep saying this, if we could just get back to what about the borrower? What about the borrower? I get it that everyone needs to make money, but what about the borrower? And how do we balance all of that? When is enough as far as earnings, et cetera? And people need a place to live. My people, and maybe it's because I've been thinking about this. I don't have a lot of borrowers who are grinding me on rate, and I think it might be because I hang up on them when they start doing that, and I don't talk to them anymore because I found myself in one of those conversations while I was out of the country, and then caught myself. I'm like, wait, I don't do this. But the loan had been referred by somebody I knew. And it was these realtors who were just trying to grind me to on this ridiculous scenario, which I had a great, amazing rate on. And I'm like, I'm not playing this game. And I'm like, I'm out. I'm just out. And so maybe that's why, Kevin, are you getting beat to death on rate? Or people just need to go buy a house to live in.
I had a client who's been beating me to death on all the closing costs. I just keep saying, I have no say over the closing costs. None at all. You know, they are what they are. If it was me and I was in your situation, the closing costs would be the exact same. I can't change them. No. Yeah.
And then what happens?
She finally, after my beatdown, she agreed and signed.
Well, I mean, if you look at don't even get me started on the closing costs. If you look at our closing costs, it's stupid. I mean, we are charging so
Well,
much money.
the problem with her was, we just have to disclose all the closing costs, whether or not she's paying them or not, because, we have to disclose what the transfer tax is. We have to disclose all these fees.
Oh,
And she's like, but I'm not paying it. I'm like, I know you're not paying it. We still have to disclose it. And you still have to sign that loan estimate or I cannot move forward. Well, can you give
yep.
me a new one where I'm not showing me paying it? No, I can't give you a new one. You have to sign the one you have. It is so silly in a way that we have to have the client sign this disclosure that is inaccurate because it's what we had when we had the information, and information has changed as the loan has moved along. But I can't undo what the initial estimate was. I can only have them sign it and then we can revise it, but we cannot issue a new loan estimate. It's
Yeah,
really,
that's rough.
yeah.
It is. Diego, you have thoughts around all this?
I do. I'll be interested to see. We had a big lawsuit about commission costs, in the real estate side of things, and so I'm sure your referral partners were caught up in this. Um, uh, Big law firms are looking at all the costs related to a home sale, or a home purchase,
Mm-hmm.
depending on what side of the transaction you're on. And there was actually just a lawsuit filed, I believe it was in Florida, against Compass, which is a big brokerage, not now the biggest brokerage, about some closing costs related to, like a brokerage fee or something. And so consumers are looking at it, but those big law firms are looking at it for class action status. And that lawsuit related to real estate commissions was painful. I mean, it definitely put the industry in turmoil for a good year or so. And it was expensive. And so, yeah, I wouldn't be surprised if these closing costs that you're referring to come up in more class action lawsuits.
Okay, so if I may, that NAR lawsuit changed almost nothing in the market. Yeah, it freaked everyone out, cost $1 zillion. The attorneys made crap ton of money.
They sure did.
And it's still business as usual, essentially. And and that is the part where, okay, so some attorney decides they're going to do some class action lawsuit and they're going to make a ton of money. And how is that going to move the needle? Because what are you going to do? You're going to tell a title company or somebody that they can't charge, what they deem to be what is necessary.
Yep.
How's that going to work?
Yeah, it's I don't think it's changed nothing. I do think that a lot of what is happening with private listings, and battles over brokerages taking both sides of the transaction have to do with that commission eventually shrinking over time. And there were, all brokerages had to figure out buyer brokerage agreements,
Mm-hmm.
so that they actually, for the first time, were signing legal documents with buyers that they were representing, which give them legal rights, but also give the buyers legal rights, and kind of lay out what services they're offering in exchange for that commission. So while in the vast majority of cases the seller is paying the buyer broker. And I think that was supposedly what the lawsuit was meant to fix. It did not. But there is a lot more disclosure around those buyer brokerage services and and what they're charging that fee for. And so I would imagine that over time, because there is more disclosure and there is that buyer brokerage agreement, we will see some shrinkage in those commissions on the buy side. Now, as a listing agent, um, from my perspective, they earn their commission. They're doing the open houses, they're helping people set the price, they're negotiating with the buyers. They're entitled to a decent commission based on that work. I think on the buy side, things will end up changing, although they haven't yet. Except in terms of the size of the commissions that have those have not shrunk.
Yeah.
So
Well,
if you talk to an old time realtor in California, that buyer's agreement was always in play. They always did that. That's not a new thing.
There
And
there are
so,
some states where that is absolutely true. And well, it's actually like it can be by MLS. What is covered and how the buyer brokerage agreement works. But there are lots of geographies where that wasn't the case. California was you could say it was ahead of the game on that one.
well, and also this idea of private listings. I mean, I challenge anyone to go to another country and try and buy a property. I was trying to figure out listings in Ireland. I've done it in England, and there's no central location, and it's a nightmare. And
no
so
MLS.
this NML, I'm not. We always want to say NMLS. MLS is
MLS, yeah.
brilliant. It's absolutely brilliant. It makes
I,
it so much easier for buyers.
I have to say that this is something, I try to be relatively neutral on these industry disputes. But what I can say is you're absolutely right that having a central location where all the listings are submitted to and where people can transact, um, it's a huge difference, and it's a huge benefit to the consumer to have that
Absolutely.
level of transparency. Like to your point, you go to other countries, you're not looking up properties on Zillow. It's
Nope.
Nope.
almost impossible.
Yep.
Um,
Anywhere. They're
uh,
all individual
Anywhere.
real estate offices. And
yeah,
I just gave up. I'm like, forget it. I can't
yeah.
even.
And there are some elements of what's happening with private listings that feels to me like we're moving backwards.
Yeah.
Where you have to go into a local office to see certain listings.
Yep.
That doesn't feel very consumer friendly to me, at least.
Nope. It's not.
I really like as a home buyer being able to, okay, like what's all available in this neighborhood that I'm interested in, or these couple neighborhoods that I'm interested in. Okay, that's got an open house now. I'm gonna go check that out. I like that level of transparency, and having to like go through backdoor channels to figure this kind of stuff out. It doesn't make sense to me.
Yeah, I
And
did.
if I may speak on behalf of buyer's agents just for a moment, I see the other side of this, which I know that the average consumer thinks, oh, just click, click, click. I can find my own place. I don't need them. Why do I need them? Right. What you don't see is a number of things. Number one, they could go show that client 50 properties and the buyer never ever does a transaction with them. They don't get paid. They don't get compensated for their expenses. There's no compensation for that footwork that people are doing on the ground constantly. The other thing too is we're in contract and you're already past your contingency period. And then one day your buyer wakes up and says, "You know what? I want to renegotiate price or I want out." And it is astonishingly important to have a really good realtor on both sides. It's not enough to have a good
Oh
listing
man.
agent. You've got to have a good buyer's agent, and they have not been trained or required to negotiate as much like the way they need to. This market is changing that. And so I say get rid of the people who aren't doing what they need to do to earn their commission, 100%. I want them out of the business on both
It's
ends, mortgage
like
and
when
real
you're having
estate.
a deal where there's an attorney involved and he's getting paid a fee to negotiate the terms.
Ugh,
Oh my God, it's the worst
nightmare.
because he gets paid whether or not the deal goes through. And so a lot of times the deal just doesn't go through versus,
Yeah, I mean,
well, there's a real estate
I'm
agent
thinking
involved.
back. I'm thinking back to when I was a first time home buyer, and the work that my buyer's agent did with me to help me find the right place,
Hmm.
qualify for the place, refer me to, a great mortgage broker, for the financing side, negotiate on the price.
Yep.
Hmm.
They helped me. I mean, I probably got, 5 or 10% more off, because they're the good ones are expert negotiators.
Yep.
Yes.
And the what there are more transactions that are happening where there's just the listing agent involved. And I really fear for the people on the buy side of that,
Yes.
especially if they're the first time home buyer, because you have to
Yes.
think about what the incentives are for the listing agent. Their incentive is to maximize the sale price,
Yep.
period.
Yep.
The seller is their client, right? And so, to have them, how can they negotiate on your behalf as the buyer
They
when
can't.
their client is the seller, right?
Yeah.
It doesn't logically make any sense. And so I completely agree with you. I do think that there may need to be ways that, the ways that a buyer's agent are paid changes, right?
Maybe. Yep.
Maybe I'm just saying maybe,
Yeah.
but ultimately there is value in a good buyer's agent. Just for that negotiating piece, just to
Yes.
have a good negotiator in the room with that listing agent or on the phone with that listing agent to make sure you get the best price.
Yep. You have to have somebody advocating for you. And
Yeah.
you as a buyer or a seller, you think because of all these shows, they make it look so easy. Every time I have never watched one of those, those high-end selling whatever highfalutin place. And you've got some bimbo who's running around doing God knows what to get God knows what. They're all making a quadrillion dollars without doing anything. That has really distorted the picture of what real estate and lending looks like on the ground with real people. And so it is it is so important that everyone involved is a professional. They are really highly trained. And again, I think the bar is too low in both industries. It's too easy for people to get in or get out and do it part-time or do it half-assed. I hate it so much. So, oh, Greg, thank you, Greg. I guess I won't say the name of the show so I don't get sued. But anyway, it is.
Yeah, but you
Yeah.
do bring up another point, and that is there is a case for silent listings, but it's a very small case, and that is for elite sellers. If you're a famous seller, you really don't want the world to know that your house is for sale and have people traipsing through your property. You want it quietly done, and you're willing to take less for that sale for
I,
that privacy.
yeah, I mean, Kevin, I even think that there are scenarios and markets where, as a seller, if you're selling into a really hot market, you may not want to go through the hassle of open houses
Mhm.
and a public listing. I can see in those scenarios, maybe you want to do a private listing, and you should have that right, in my opinion.
I agree.
But it should be well disclosed,
Hmm.
beyond any shadow of a doubt that you could get less money from a private
Yep.
listing than you would get on the public markets. It's just, you know, the auction economic, the auction economics of it, kind of dictate that in a lot of scenarios, if you do a private listing, you are going to get less, right? You are getting, by the nature of a private listing, fewer qualified
Right.
buyers and offers that are
And,
seeing
and
seeing your property.
Yeah,
Yep.
and some people are people, they're good with that sometimes.
Yeah,
And the best
exactly.
case of that is, all these home buyer ads you hear all the time. There's one in particular in the San Francisco area that's, on every other commercial, we buy Bay Area homes, blah, blah, blah. And they've been responsible for 2 loans I've gotten because they pulled out at the very last second.
Oh,
And
interesting.
yeah, and then I kind of sweep in and get the people the money to get their mortgages whole, whatever it was, and then get them to, list the price for what it should sell for with a real agent and get them the money to stage it and that kind of stuff. But it's like, yeah, it's really surprising how these guys come in and they'll at the last second bail because they don't do their full due diligence and they, oh yeah, well, we'll look at Zillow and it's, they always come in well under. So like I have a case right now. All the homes in the area were going for just around $950,000, and this gal was in contract with one of these guys for 725, and he pulled out. And it was funny because I said, well, that's such a. She then put the place up on the market at 725. She goes, I'm going to be happy to get 725. I don't want to mess around with it. I just want out and done. And I literally looked at it myself. So maybe this might be a good opportunity for me to buy a place and fix and flip it. And I did the math, but the holding costs are the big expense. And I was
Yeah.
like, I'm looking at making $30,000 on this, but I'm risking, $750,000.
I mean, that's why I buying has been so challenging. It's such a challenging business. Is
Yeah,
that
Well,
is that is
and
that is that on a national scale, the holding costs end up being tricky
it's
for sure.
huge. Yep.
Yeah.
Yeah.
but also if you look at the iBuying closing cost or estimates, I mean, so they'll tell you, oh, we're not charging this and this, so you think you're getting a good deal, but if you look at the actual estimate, they've added, I mean, the fees are extraordinary,
Totally. No,
and they're so
they're making
bad.
money.
It's so oh my God. Okay, so I just wanted to say what you were saying something about disclosure, making sure disclosure, and I'm going to just point out that they've added so many disclosures which nobody reads anymore. So
That's a fair point. Yeah.
I used to sit down with my borrowers. We just go through page by page, and I would just, even whether it was on the phone or if it was in person, and I would tell them as they were signing each page what the synopsis of that form was, so they had some sense of what they're signing. Now, click, 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 click. Nobody gives a crap. Nobody's looking at anything. It is such a disservice to the borrowers. And I just, and again, I like the convenience of e-signing very much. There are times it is so useful, and I get it. But borrowers are not reading disclosures, Diego. They're just not.
Yeah, I mean, I mean, in this specific scenario, this is a disclosure that you would have to sign before you sign your listing agreement with the
Right.
listing agent. And I'm sure there are other disclosures that you're signing at the same time, and you may be
Many,
right that people will just
many.
flip right through it. My point is, um, uh, I think that there was some kind of survey done over the last couple of years, and asking about private listings. And in the first pass of the survey, people were like, "Oh yeah," it was like 30% would be interested in private listings.
Mm.
When they were told, "Okay, if you do a private listing, it may mean that you make less money," well more than half of that 30% said, "There's no way I'm doing a private listing. I'm not even going to think about it." So again, to Kevin's point, to my point, there are scenarios where a private listing could make sense,
Mm-hmm.
but it is nowhere near the majority of scenarios. It's probably not more than 5% of the scenarios.
Yeah.
And so what's happening right now is a huge fight over maybe 1 to 5% of the potential transactions that are out there. But to me, the reason that fight is happening is I think that there are some brokerages that want to double dip, right? They want to be on both sides of the transaction. They want to make more money. But again, I go back to that just sort of thinking logically about it. If you have one brokerage on both sides of the transaction, are both sides of that transaction getting a fair deal?
Nope.
Logically, it doesn't make sense. Maybe they can structure it so that they do. They create, firewalls and, arm's length relationships inside the brokerage. It's really tough.
I know.
And so if I was buying a house, I would not want to have the same brokerage representing me that's representing the seller. That just doesn't make any sense.
It is. I'm not a fan of double dipping at all, whether it's real
How about
estate
or
or,
triple dipping when they do the mortgage also?
yeah.
Oh, good point.
That
Yeah.
never works out for well for the borrower.
Okay, so I just briefly want to just remind everybody that although has been opposition to the condo rules that are about to change, it hasn't happened yet, and so we are going to need full condo reviews starting August 3rd, unless something else gives. And also, the 15% reserve requirement goes into effect January 4th, 2027. And we've got a lot of HOAs. I mean, I've seen huge, ridiculous numbers across the country of how many HOAs do not meet the guidelines and are not warrantable. So just be aware. And again, I think for the buyers, it's helpful for them to go in eyes wide open and know everything. For the people who own those condos, it's rough right now. And so really be an asset to them. Be really clear on what non-QM lending options are, and figure out how you can help them. So we're almost at the end. And I wanted to ask you, Diego, what you are hearing on the ground from lenders across the country and people in the mortgage space. What's the sentiment like, and how are people feeling, that you come in contact with?
Yeah, I mean, I think people are feeling in some ways a great year was taken away from them.
Mm,
Right? Like
yeah,
if you go back to January,
February.
February, whoo, I mean it seems like mortgage rates were going into the high fives.
Yep.
There was this demand was clearly showing up and ready to party in the spring housing market. And I think there was a lot of planning that it was just going to be a really strong year. And I think it's going to end up being a mediocre year, kind of like the last year was. But certainly mediocre is better than bad, which is where we were for a couple of years. And
Yes.
so for me, I think when I talk to people, it's sort of like they're kind of like going through that shift of like, oh, it's too bad that it was supposed to be such a great year, to like, okay, like it's better than last year, like I'll take it. The one issue that some folks are running into, is there were lenders in particular that were kind of just holding on for that really good year.
Yes.
And maybe we're thinking about selling, but didn't sell because it was going to be a really good year, but now are back to thinking about selling. So I think we are going to see more consolidation over the rest of the year.
We are seeing a lot of consolidation. We certainly have had it in our company. So, and I mean, just the merging of people who have um, things that complement each other, different parts of the business that complement each other, bringing it together and then having that increased volume, get them better deals or put them in a better position in the market, which I think that can be positive in certain situations. So it's, I agree. I've heard the same thing where people are like, oh God, we were hoping this was going to save us and make up for the last few years. And again, I think that if we are all living for that next refi boom, you have positioned your business incorrectly. It
Yeah.
is when I first started in the business, again, probably before you were born, we really focused on purchases. There weren't a lot of refis. That was not what we did. And again, it was about getting people into homeownership, helping them find a place and, find investment properties, et cetera. So when we get a refi situation, great. But also we get an influx of ding dongs who have been sitting on the sidelines, who don't know what they're doing. They come in, they take the low hanging fruit, and we're all left. I mean, I would rather chew on glass than have a repeat of 2023,
Yeah.
24. It was miserable. And it just pisses me off that these people are so easily brought back into the business. They do what's easy. They make a ton of money. They leave all the crap for us to deal with. No, no, no. But that's just my opinion.
It's good,
Diego,
good place
Really?
to
You're
leave
both silent?
it.
That's it? Nothing? Oh
Yeah.
my God. So anyway, so Jenny says we're rebuilding our refi market. And Greg said that the trend line for listings and interest rates are both moving in a positive direction. Listings are on the rise, however slow, but in the right direction. Government buying MBS and inflation trending lower. we know that that will not turn quickly until the Iran issue is corrected, if it ever is. So again, tech has not decreased our cost by any stretch. It'll be interesting. I keep watching this play itself out. I'm very interested in how it goes, and I know that you've spoken to this too, Diego, and that you're in agreement that we're this tech is to complement the humans and to help us do a better job, be more efficient. It doesn't replace humans in most situations.
Yeah, I
So,
mean, I think it helps with the flight to quality, right? Like,
yep,
with the professionalization of mortgage and of real estate, um, and good LOs use tech well,
yep,
and you should complement good LOs with good tech.
yep,
You're right. I don't think you replace good LOs with tech, and I don't think you should even even try,
yep.
especially for the work with first time home buyers. Like, it's just too those transactions are just too complicated. Now, with refis, that can probably be a little bit more tech enabled, but for the most part, good LOs I feel like are pretty safe from all these changes.
Okay, you and I always like that's the one point where I'm like, you and Mark McCardle, he used to say, "Oh, in refis," I'm like, "Yeah, nope." So it again, you need strategy, and
Well,
even on
100%.
a refinance, like
Good,
I've got this
good,
guy
good,
who makes a
good, good,
zillion
L, good,
dollars.
L, good, L, good LOs are good on purchase and refi. I have no doubt. I have no doubt about that. It's just, and it's the same with good real estate agents, right?
Right,
Like, uh,
100%. Oh my God. Okay, so Greg said he's going to try chewing on glass just to feel the pain and that there will always be room for great LOs. Yes, that is true. So come and see us at summer camp in Irvine. It's coming up soon. We would love to see you there. Make sure you've signed up. Diego, any last thoughts before we check out?
no, it's been great chatting with you. And we are going to launch something called Housing Wire Intelligence on August 19th. If you're interested in learning more about the data that we've got and the news that we publish, just come to housingwire.com. That's where all the magic happens related to
So
Housing
wait,
Wire.
is that where I have my subscription to Housing Wire? Is
Correct.
housingwire.com? Okay, well
Correct.
then I will go there because I have a subscription. So, with that, we adore you. Thank you always for being here. We appreciate it so much. Everyone, there are loans. They're hard, it might take you a bit, but they need your brain and they need your strategy. So, go get them, close some loans. Have a great week, everyone.